As was widely anticipated, today the Bank of Canada announced that it would hold its overnight rate at 5%. Governor of the Bank of Canada, Tiff Macklem, highlighted two key points that the bank is focused on right now. The first is that inflation is still too high. The bank is resolute to get inflation to its target range of 2%. The other point of focus is a shift from asking if rates are high enough to bring down inflation to how long rates will need to remain at current levels. We'll unpack both of these points and then I'll share my opinion of when the first rate cut might happen. The first area is that inflation is still too high and needs to drop further. This is considered to be hawkish commentary because it suggests that the prime rate will remain elevated for a while longer to get inflation down. Some of the wording included in today's Bank of Canada commentary was that underlying inflationary pressures are remaining. There's more work to be done, and it's too early to discuss a rate cut. So it doesn't sound too optimistic that rates will be cut anytime soon. In fact, as can be seen in the chart here, based on the current trajectory and accumulating downward momentum in the economy, the Bank of Canada has projected they expect inflation to remain around 3% until the June-July timeframe. But even once inflation dips below 3%, the bank will want to ensure that it's close enough to 2%, or at least well on track to 2%, before they consider a rate cut. So this would potentially bring us out to the fall before we see a rate cut. This brings us to the Bank of Canada's next main point, which is that rate seems to be high enough to get the job done. This is seen as a more dovish, more optimistic commentary because it suggests that the bank does not see rates needing to go higher at this point, and that without actually coming out and saying it, that it's just a matter of time until there's a rate cut. Some points leading to more optimism that rates will be cut sooner this year include that the Bank of Canada sees economic growth returning in the second half of 2024. Given the economic decline we're seeing now, that would require lower rates. Also, as the Bank of Canada does see inflation trending down towards 2% later in 2024 and hitting 2% in 2025, this suggests that lower rates and lower mortgage rates will be contributing to a 2% rate of inflation. Financial institutions and economic research firms back up this sentiment that rates should be cut sooner than later. As seen in the chart, CIBC Economics sees consumer spending approaching recessionary levels, and although not quite at the point of recession yet, we are very close to it, and will likely hit recessionary spending levels soon. The red bar on the chart shows as spending declines in previous recessions, while the yellow bar shows current spending is tracking downwards. As employment weakens, CIBC is also seeing a vicious cycle forming where it will take more rate cuts than currently anticipated to balance out the economy. Oxford Economics, an independent economic research firm, goes a step further than CIBC, asserting that we are already well into a recession, pointing to GDP per capita declines for over a year now. They go on to explain that Canada is heading towards more of a severe, hard landing recession and that we're likely to hit that sooner than the Bank of Canada thinks. They argue that more aggressive rate cuts will be needed in the next 2 to 3 meetings to avoid the hard landing. Finally, when we look at the reaction of the interest rate sensitive Canadian bond yields today, we see little change in the market expectation for 1% worth of rate cuts over the next year, starting in April. So, what do we make of all this? And when should we anticipate the Bank of Canada to cut rates? We've reviewed several projections and predictions, but there's one thing for certain, and that's the Bank of Canada is resolute in its position to see inflation hit the 2% point. In its resoluteness, I believe that the Bank of Canada will rather err on the side of overcorrecting with higher rates for longer than risk a rebound in inflation. History has shown us that it's easier and faster to stimulate the economy by aggressively cutting rates than it is to repress the economy and inflation by increasing rates. The main trend we've seen over the past 2 years is that inflation is stronger than we've thought. We've also seen that the Bank of Canada has been incorrect with its guidance on several occasions, and any optimism has been let down at pretty much every opportunity during this economic cycle. So, to err on the side of caution, I expect rates to be cut later. This could be as early as July, but with good possibility of a fall cut. This later cutting would also mean more aggressive cutting instead of a series of 0.25%, 0.25 cuts. We may see some 0.5%, 0.5 cuts. While in 2024, it's okay to be more hopeful that rate cuts will come, we want to try to avoid more letdowns and also prepare ourselves financially for the possibility of a longer wait for cuts. Given this, for those looking for a mortgage renewal or to buy in the coming months, a shorter term fixed rate, such as a 2 to 3 year fixed, is likely a prudent decision, while variable rate offers higher potential for reward with a higher rate currently. There's also a risk that rates could take longer to drop. Thanks so much for watching. This is the first episode, and I commit to making these presentations better for you. Click like and subscribe today and comment below. Thanks very much.